Hello everyone, this is Pranshi Verma. Welcome to the session MBA interview guide for your upcoming interview in digital marketing field. Guys, today's topic is frequently asked leveraged buyouts question and answer. This is very important session for you. My dear students, listen to me very carefully till the end of the session. Now, let's begin. In leveraged buyout question answer, your first question is, what is leveraged buyout? Okay, answer is, a leveraged buyout is an acquisition of a company using a significant amount of debt to meet the cost of the acquisition. Okay, so this is pretty simple and one line definition of leveraged buyout. Next question. Name three core components that contribute to the success of a leveraged buyout. So first component is cash availability, interest and debt paid down. Second component is operation. It's include EBITDA improvements. And third component is multiple expansion. Next question. Name 4 exit strategies to a leveraged buyout. Answer is 4 exit strategies to a leveraged buyouts are: first one, strategic sale; second one, sale to another financial sponsor; third one, IPO; and fourth one is dividend recapitalization. Next question. What are some characteristics of a company that make a good LBO candidate? So some characteristics of a company that make a good LBO candidate are: first one, steady cash flows; second one, opportunities for earning growth or cost reduction; third one, a high asset base means collateral to raise more debt. Next question. What are the 3 main steps to conducting a leveraged buyout analysis? Answer is, for conducting a leveraged buyout analysis, first step is obtaining a purchase price. Second step is estimating source and uses of funds. And third step is calculating investor rate of return, means IRR. Okay. Next question. What is the purpose of a leveraged buyout analysis? This is very important question. Answer is, a leveraged buyout analysis helps determine the annualized returns IRRs of an investor's equity investment in a business after a specific time horizon. Okay. Next question. Walk me through a leveraged buyout analysis. Answer is, in order to determine the IRR of a particular investment after a certain number of years, one first needs to establish the purchase price of the business. After estimating purchase price, one needs to determine the entire uses of funds, means purchase price, net debt and transaction fees, and the sources used to fund the acquisition, means some combination of terms, loans, high yield debts, mezzanine and equity. Okay, focus on that point. One can then construct a simple unlevered free cash flow analysis that will provide a projected EBITDA for estimating an exit and total cash produced for paying down debt. The projected EBITDA is multiplied by a multiple to get an estimated exit value. Of one, the purchase multiple is used as an estimated exit multiple. In order to establish return, one needs to calculate the final debt and the original debt raised to fund the acquisition plus the total interest incurred is calculated. One can estimate total interest by taking each annual interest expense multiplied by the number of years and multiplied by 1 minus tax percentage. Then the sum of the original debt raised and the total interest expense less the sum of the unlevered free cash flow is the final debt balance. Then the return is the exit value, means from the EBITDA times the multiple less this final debt number, and one can then compare the return with the equity originally invested in the business to calculate the IRR. Okay. Next question. What are the some major difference between a basic LBO analysis and full scale LBO model? Answer is, there are many differences between a basic and full scale LBO model. One major difference is that simple analysis would just contain a simple cash flow build-up, whereas a full-scale model would contain complete projections. This would include the income statement, cash flow statement, balance sheet, as well as the supporting schedules. Now, at the other hand, a full-scale analysis would also include balance sheet adjustment and a more detailed look at the balance sheet post-transaction adjustment. Another major difference to highlight is the simple analysis estimates interest in 1 year and multiplies by the number of transactions year of to estimate total interest obligations. In reality, if a company is paying down debt each other, the interest expense should also be reducing because a full-scale model contains a debt schedule. It will more properly associate declining interest in line with debt paydown. Next question. What are some common types of debt raised in a leveraged buyout? Answer is, although there is a vast range of possible securities utilized in funding a particular LBO transaction, but they can come in several major categories. Bank debt, high yield debt, and mezzanine debt. Bank debt or a term loan is the most fundamental type of debt. It usually carries 5% or 12% interest and can be backed by the core assets of the business. Such debt can be revolving line of credit, a term loan, and other subordinated loans or notes. High yield debt is a more aggressive type of debt borrowed at much higher interest rate to compensate for additional risk of defaulting on such debts. Interest in such debt can be upwards of 15%, but it varies depending on the situation at hand. Mezzanine or convertible lending is a hybrid between debt and equity. The general concepts of a mezzanine security is that it's initially considered debt that will convert to equity after a certain amount of time or after certain hurdles are met. Okay. Next question. What are the most common variable in an LBO analysis? Answer is first one, purchase price. What is purchase price? Purchase price, the higher the purchase price, the more costly an investment may be to the investor and therefore the lower the IPR. Second one, sources of cash. In this, the amount of debt that can be raised to make such an investment will also affect the IRR. The more debt we can raise, the less equity we have to put in. So the higher our expected returns will be. Next one, interest rate. Interest rate is a lower interest rate would lower our cost, which would increase our cash, which would allows us to pay down debt faster and increases the IRR. Next one, time frame. Typically, a shorter time frame would produce a higher IRR. In next one, operation performance. It's included EBITDA projections, and this the more we can improve EBITDA, the higher our potential sale value, which would increase IRR. Also, a higher EBITDA would improve our cash flow. Okay. Next one, cash flow means UFCF projections. Its improved cash flow performance will allow us to pay down debt faster and will improve our IRR. Next one is exit multiple. The higher our exit multiple means exit value and the higher our return. Next question. Name 4 sources of funds in a leveraged buyout from least to most risky. First one, bank debt. It's included term loan, notes, etc. Second one, high yield debt. And third one, mezzanine funding. It's include convertible securities. And fourth one, equity. Next question. Name the 3 methods of acquiring a business. Answer is first one, asset acquisition. Second one is stock acquisition. And third one, 338H10 election. Next question. Name the core users of funds categories. Answer is core users of funds categories. First one, purchase price. Second one, net debt. And third one, transaction fees. Next question. What is one way to conservatively estimate an exit multiple? Answer is often one can conservatively assume the purchase multiple will be the exit multiple. Next question. Name one way to calculate IRR. Okay, answer is IRR can be calculated as exit equity value divided by equity invested, key power 1 divided by years minus 1. Okay, this is very important formula and kindly learn it, guys. Next question. What are the major variables to an LBO analysis? Name at least four. So the major variables to an LBO analysis are purchase price, second one source of cash, third one interest rate, fourth one time frame, fifth one operation performance. It's included EBITDA projections. Next one cash flows. It's included UFCF projections, and next one is exit multiple. Next question. What are some advantages of LBO financing? Answer is advantages of LBO financing. First one, the more debt used to make the purchase, the less equity needed, which can maximize potential returns. And second one, interest payments on debt are tax deductible. Next question. What is the advantages to using leverage when making an acquisition? Answer is the more leverage used to fund an acquisition, the less equity needed, and less equity invested will maximize your return. Next question. How can one determine the amount of debt raised? Answer is one can use debt multiple as comparable matrices to other similar leveraged buyouts. Next question. Would you rather have an extra dollar of debt pay down or an extra dollar of EBITDA? Answer is this is very interesting and important question. You would rather have the extra dollar of EBITDA because of the multiple. At exit, the sale price is dependent on the EBITDA times the exit multiple. So an extra dollar of debt pay down increases your equity value by only $1. An extra dollar of EBITDA is multiplied by the exit multiple. Next question. Name several strategies to maximize returns in an LBO. Answer is first strategy to maximize returns in an LBO is minimize equity invested. Means this can be done by increasing the depth used. Okay. Second one, reduce the purchase price. Third one, increase the sale price. Fourth one, increase EBITDA, means cutting cost or boosting revenue. And fifth one is maximize cash flow. Next question. What is dividend recapitalization? Answer is in a dividend recap, the company reverts means raises debt on the balance sheet. The new money raised is often paid out as a dividend. Next question. What is the advantages of performing a dividend recap? Answer is a dividend recap could have several advantages in maximizing returns. One common advantage is to extend the holding period of the company while still raising cash to expand for the fund's need. If the market environment is not the best for target company exit, a dividend recap would allow the funds more time to look for the right exit opportunity. Next question. What cost of equity discount rate would you use to value a target company in a leveraged buyout using a discounted cash flow analysis? Answer is you would often use a rate that reflects the expected equity returns of the fund. If the fund is expecting the 25% returns, this could be the rate to use. Okay. Next question. What is a PIK security? Answer is a PIK, P-I-K in capital. Security is a paid in kind security. Okay. The periodic interest obligations are satisfied means in kind, meaning in something other than currency. Typically, when the interest obligation comes due, more debt is raised to meet that obligation. This results in interest on interest, which can get costly. On the other hand, it reserves cash or other beneficial uses. Next question. What is the purpose of a seller note in a leveraged buyout? Answer is a seller note is a loan to the purchased business from the seller. If a certain purchase price is negotiated in an acquisition, a certain amount is of course paid immediately, and the rest can be deferred as a seller note payable in certain terms. This can be used to prevent the seller from starting a competing business or can incentivize the seller to continue to support the business. Okay guys, now let's wind up the session. See you in the next session. Guys, I request to you, if you want any help in any subject for any interview purposes, for any regular examination purposes, kindly let me know in comment section. I will be help you surely. Please subscribe to my channel for more updates. Wish you very all the best for your all interview, for your all regular examination. Thanks for watching this video and please share this video with your friends. Thank you.